One of the things I've set out to do with my whole life, my whole career, is to build a financial market that's the opposite of that, where it's not run by lots of brilliant people doing complex math. It's run by computer code doing math. And it's doing it as open source computer code in a way that anyone can have visibility into, anyone can audit, anyone can inspect and understand the workings of this financial market. This is what we call DeFi today.
If there was someone or something controlling Bitcoin, you wouldn't trust it enough, I guess, to give them $1 of your money because you would assume they might do something funny in the long run. Or
if Bitcoin were run by the Bitcoin Corporation, it would be worthless. The value of Bitcoin comes from the fact that no one person controls it, right? And that means that no one can shut it down. It's going to run forever. It's like extremely anti-fragile. Its decentralization is what gives it value. And if it wasn't decentralized, I wouldn't pay $1 for a Bitcoin. I think the biggest challenge is convincing people that DeFi and crypto is not only here to stay, but is better than existing financial systems. And just opening people's minds to the fact that eventually most assets are going to live on blockchains instead of traditional financial markets, and they have to start getting prepared for it today. Oh, we'll be fine, we'll figure it out. But they're not going to figure it out by doing nothing. And a lot of them have this delusion still that they don't have to change anything or get started.
the world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is...
This is London Real. I am Brian Rose. My guest today is Robert Leshner, the former economist turned entrepreneur and decentralized finance innovator. You are the founder and CEO of Compound, the software development company that is revolutionizing the entire DeFi ecosystem. Your company played a key role in the explosion of cryptocurrency yield farming during the DeFi summer of 2020, a year when the total value locked in decentralized finance grew a staggering 88 times, according to Forbes magazine. Compound was also a pioneer in the space of blockchain governance and the issuance of governance tokens, and you have been at the forefront of helping to grow the blockchain space, investing in crypto platforms like Argent Wallet, Open, and Blockfolio. Robert, welcome to London Real.
Thanks for having me. Excited to chat today.
Great to have you here. I got so much to ask you and so much to talk about. I actually started my career in finance, and I was in New York City in the 90s, and they were recruiting engineers from MIT to be like their rocket scientists on the desk. And so I went into fixed income, and I got dropped into a group that was doing all these complex financial derivatives, Robert. All these really fascinating things like option trades and, time trades, and it all had to do with the financing and treasury curve. And it was a fascinating place to be. And I was really excited to be there. I moved on to Chicago. I came here in London to do credit derivatives, but then I stopped and I started broadcasting for 10 years. And so I really hadn't been involved in this space, Robert. And about 4 or 5 months ago, I looked at what you guys were doing and I thought, wow, this reminds me of what we were doing in the 90s, except you don't need 10,000 employees. You don't need a balance sheet. You don't need a direct line to the Fed. You got, 4 guys and a dog in Tel Aviv, or 3 girls in St. Petersburg with a cat, or who knows where they are, putting up these DeFi protocols, and the innovation was amazing to me. I mean, I used to trade in the repo markets where we'd have to swap a government security, right? 30-year treasury or 2-year treasury and get a yield. And I was like, wow, look at what they're doing. And it's so exciting to watch. And so we've kind of gone all in the ecosystem. We've created an academy. We're teaching hundreds of students. And so I'm just super excited to have you here to talk about this stuff. On my show, London Real, we had conversations about crypto and DeFi over the years, but we couldn't put the pieces together. I had Max Kaiser here in 2013 talking about Bitcoin, screaming about Bitcoin. I had Andreas Antonopoulos on the show in 2015, 2017, 2019. You know, Robert, talking about the future of money, the internet of money, but it hadn't happened. Now it clearly has happened, and thanks to the work that you're doing at Compound. And so let's jump into it. I figured maybe we just jump right in to summer of last year when your platform is just going up, 10x in volumes, and something that I'm sure you guys always believed in becoming this reality. Can you maybe walk us through what some of those days and months were like, and maybe explain to people what was happening and why it was so important?
Yeah, so I'll start with the history. And I'll try to tie it back to your experience trading with very math-based products, right? Where markets were really, created and run by really smart guys. People were coming in doing rocket science, trying to price, different financial instruments, trading them, having internal workings, trading with counterparties. That's the way finance is always basically operated. I started my career in finance in 2007. And this is right as global markets started to enter into an incredibly dark moment where the global financial system started to melt down. And when I looked around, I saw it was melting down because you had all these smart people that all knew what their positions were, but nobody else knew what any other bank or any other counterparty held. It was a guessing game. And there was whisper campaigns and guesses all across Wall Street and all across global financial markets as to the health of counterparties. And so what the system was actually doing or how different things were going to price or unfold. And nobody knew what was going on. It led to this global calamity, right? And so one of the things I've set out to do with my whole life, my whole career, is to build a financial market that's the opposite of that, where it's not run by lots of brilliant people doing complex math. It's run by computer code doing math. And it's doing it as open source computer code in a way that anyone can have visibility into, anyone can audit, anyone can inspect and understand the workings of this financial market. This is what we call DeFi today. It's replacing all of the really smart people with all of their own proprietary information with financial markets run by a program. And these programs exist on blockchains. And this idea, when we sort of came up with it, in 2017, was crazy. It was, novel in a lot of ways. There was no real examples of DeFi applications that were working or had critical mass scale yet. And so Compound is an attempt to create an interest rate market using computer programs. We started this in 2017, and it was a couple of years until last summer when things started to really take off. Now, Compound lets you do two things very simply. One is you can borrow assets using crypto as collateral. This computer program manages the entire process. You post your collateral directly to the program. It holds the asset for you, and it says you can borrow this much. It manages the risk and the liquidation of your position, and it ensures that you don't pose any systemic risk to others. And it lets you borrow anything you want. Typically, people are borrowing stablecoins. On the other side of this, it allows users, whether they're individuals, hedge funds, other financial applications, other DeFi tools, to earn an interest rate by simply providing liquidity to the borrower. And, it was last summer that this really started to take off. We launched Compound in 2018. It was very simple. You could earn interest and you could borrow crypto assets. By the end of 2018, there was maybe $20 million of assets in Compound, which was, as a proof of concept of a completely different approach to creating a financial market, phenomenal. By the end of 2019, the number was about $100 million. It started to grow, but again, the concept of DeFi was still relatively limited. There wasn't that much assets in aggregate being, put into these new financial applications. And then in the summer of 2020, we did something that was transformative, which was we took a protocol which was running, had $100 million in it. It was providing $100 million of interest-bearing assets available to one side, and people are borrowing them on the other side. And we said, no longer is this system going to be run by the team that built it. And instead, what we're going to do is we're going to hand off the administration of this market to the community. And all of the governance of it and all of the value of it is going to accrue to the community instead of the original team that built it. And this was one of the first times that you had seen a platform that started off centralized move to decentralization. Certain assets like Bitcoin were lucky in that they started off from a very early point, not very decentralized, but they started off in a state in which incentives and competition created a decentralized structure. And this was one of the first times that we were going, through a transformation of an in-flight system that was managing a huge amount of money. And this was really exciting. And so this set off an explosion of new ideas on just how users interacted with DeFi applications. We began giving away ownership of the protocol directly to the users, led to this flywheel effect where there was more users who wanted to participate in the market because they were going to become owners of it. It created a huge amount of awareness and visibility. And it created, a set of incentives that got people to participate in actually taking ownership of this system and feeling like they had a vested interest in the success of it. And it was a wild time. I think since then we've seen this become a playbook and a template for a lot of different new DeFi applications to launch a product or a market, and then as it scales, hand it off to the community so that it can become anti-fragile. There's a huge, collection of interested stakeholders that want to see it succeed as opposed to one. So that was the most exciting summer that I've ever seen.
And so you think that wasn't a coincidence? Do you think that when you made that governance decision to kind of open source it and also, first of all, give the ideas to the community so they could flywheel it and also give them the ownership, that wasn't just a coincidence with everybody wanted to do yield swapping at the same time? They were hand in hand.
Yeah, they were. And, we also didn't know what to expect, right? So, when we first started building Compound, the idea of, computer code, running a market without tens of thousands of employees and without buildings and without control, essentially, this was a radical notion. And then the idea of giving it away, as it was succeeding was in some ways even more of a radical notion. A lot of, the stakeholders that we had, like investors in our business, were a little terrified of us essentially giving away something that we had built that was working, that was scaling. But I think at this point it's become, almost an understood concept that this is feasible and it can work.
It's such a radical concept. I'm thinking of my equivalent on Wall Street. So when I was on Wall Street, I'd be sitting on, hundreds of millions of dollars of government bonds overnight, and I would repo them out. So just people would know, as opposed to just sitting on them and getting no money, I could lend them out overnight and someone would pay me, Fed funds rate, 3 or 4%. Or if they were really hard to find, I might get paid something nice because people really wanted to grab them to sell them. And so usually I call my own repo desk. Maybe I could call another institution and get a rate, and it might be a little bit better. Now, the equivalent is Compound comes out and says, guess what? First of all, we'll show you how you can do your own repo, and we'll also give you part of the company is a bonus for doing business with us, and you can tell us how to run the company. If you told me that on Wall Street, my brain would have fried. The only thing I ever got offered was a steak dinner or tickets to see the Knicks. That's the way they would incentivize in the past, right? There was it going on, but it was never this way of doing it with a token. And then the token has a mark-to-market immediate value, and it created this crazy flywheel of critical mass that, again, that could never happen in the centralized finance world I knew of the past, right? But in DeFi, well, you guys made it happen, and people could see it, and obviously they believed it, and they participated in it. And again, people got the yield, and they got comp tokens along with that for doing business on your platform, and that kind of made it really explode.
Yeah, and today, there's about $18 billion of assets earning interest in Compound, which is a number that, was hard to fathom a summer ago. And it has succeeded in that sense and has built up a pool of liquidity that's now institutional at scale, where you can come into Compound and borrow $1 billion, and that's something that you never could have done, prior to the introduction of this complete ecosystem.
Right. And you say the word institution, and I want to get to that because that's kind of, I think, a lot of where you're heading with Treasury, and you kind of want to bring in, I think, the centralized institutions and get them to be working on your platform. And I definitely want to talk about that because that gets really interesting for people that are still coming up to speed here. I had one of my students the other day, and I want to talk about stablecoins too, but they said, why is this such a big deal? Because I get them to go on like Compound and borrow and lend an asset in small size just so they see what it is, because most people have no concept of this, right, Robert? Because we know our stockbrokers, was the best kept secret for a long time. They would hold our shares and lend them out overnight when we just thought that you couldn't do that. So how do you usually educate people on the fact of financing assets? Because we don't normally, Airbnb maybe is an example, I guess. We don't normally finance our cars. Or how do you usually explain that? And why is it such an important building block to the whole system?
Yeah, it's a great question. So, you mentioned a point, which is, all the stocks in the world, that most people are sitting on, overnight, their broker is lending them out to a short seller or in some way to like earn just a little bit of extra income for themselves. And most of that value doesn't accrue to you. The idea behind Compound is that, originally we thought, okay, all idle assets out there, and starting with crypto assets that were available on the Ethereum blockchain, if somebody wants to borrow them, it should be freely available. And the people with the asset should be receiving the yield from that behavior. And so, one way to think about it is, people will borrow the assets that you have. If they're borrowing stable coins, they're excited to borrow these stable coins to buy other assets, to essentially, convert the stable coin into more Bitcoin, into more Ether. And then over time, hopefully pay it back. Bitcoin or Ether have gone up, they sell it, they repay the stable coins they've borrowed. Or if somebody's looking to borrow Ether, either to like run smart contracts or to sell Ether for something else, or to purchase an NFT with Ether, because that's the only thing that can purchase the NFT, they might borrow Ether. And all of this leads to this process of people paying for the opportunity to borrow assets, and paying the users that provide those assets directly. And the system works in a single player mode basis, where you can just go to the protocol and take the prevailing yield, or you can borrow at the prevailing interest rate. You don't have to call anybody. It's not like, if you wanted to like get an interest rate on a treasury, having to like work the phones or work the desk or like work chat rooms. It's a system that's designed to be, one in which you can just directly interact with the protocol 24/7. It could be 3 a.m. and you could be wearing your pajamas, and the system just works. And so the easiest way to think about it is, if you have crypto, there's a yield available to you on that crypto. And if you want to borrow any of the different crypto assets for any reason, you can do so using other assets as collateral. So the most popular use cases are people taking a basket of volatile crypto assets, whether it's Ether or Bitcoin or Uniswap tokens or whatever, and borrowing stable coins against it, or providing stable coins and other crypto to the protocol to earn the prevailing rate. And the most popular trade has always been borrow stable coins to buy more assets with, or go put to productive use in the real economy, or do anything you want with, against crypto, and other people providing stable coins to earn an attractive yield relative to traditional financial markets. Right now in Compound, stable coins all in earn about 3 to 5%, which most folks are interested in one way or another.
Yeah, well, we mentioned stablecoins a few times there, so we probably should talk about like what these curious instruments are. Again, that's one of the things that caught my eye when I took a double take at this market, and I thought, wow, that's some serious innovation. But I had a student the other night on my course, and they said, I'm looking at this stablecoin, Brian. I don't know what to do with it, because if I invest in it, it doesn't go up. It seems so boring, and what's the point? And I laughed, and I thought, how can I explain this? And I thought, you know what? I like boring. There's some times where you like boring. I have 2 young boys, they're 4 and 5 years old, and they have a babysitter. When I come home at night, I want to see boring. I don't want to see somebody dancing on a pole, with the whiskey out and some party. I want boring. I want something that's not volatile, that I know is going to be there. I moved into a neighborhood where nothing goes on, right? And that's a beautiful thing. And so I tried to explain that a stablecoin does that similar thing, where everything else can be chaotic and up and down. The only thing I promise you is boring. Stability. It will most likely be this one thing, and we're going to try really hard, and the track record shows we can pretty much do that. But that in itself is incredible value. And maybe you can talk about this, because this is also the embodiment of a smart contract. And it also, I think, even surprising to you, has become one of the biggest uses of of blockchain, of your platforms as well. Who would have thunk a few years ago? So again, maybe you can talk about some of those points.
Yeah, and all that makes a lot of sense. So a stable coin is a crypto asset that's meant to be representing exactly $1. And there's a huge demand for these stable coins because relative to dollars in a bank account, stable coins are much more portable. You can send them to anyone, anywhere in the world at any hour. They, can cross capital markets. They can cross geographies much more easily than dollars held in a bank account can. Even just wiring money to someone is like a chore. It often involves like visits to a bank and like $15 fees, and it takes hours and multiple phone calls, right? Stable coins are like the most portable version of a dollar. You just can keep them in your crypto wallet, and you can send them to anyone else's crypto wallet very simply. It could also, be sent to, a DeFi application. And this is the second advantage of stablecoins, is that they're programmable. So anyone out there who's building a DeFi application can very easily program stablecoins. They can build interest rates into markets for stablecoins like Compound. They can come up with tools so you can trade stablecoins for other crypto assets and vice versa. They're more useful than dollars held in a bank account because you can trade them, you can program them, you can do all sorts of extremely complex and rich behavior with them. So, imagine the international demand for dollars. It's huge. It's off the charts. Imagine the international demand for better dollars that are more portable and they're programmable, and you can interact in all sorts of ways with them. That's a stable coin. And so what's happening is there's lots of like dollars that were being held in bank accounts that are moving into crypto. People are trading or buying stable coins with dollars. They do this through Coinbase. They do this through exchanges. They're converting dollars into stable coins because stable coins, for a lot of use cases, are just better than dollars held in a bank account. And likewise, there's a lot of people that are borrowing stablecoins. It's extremely hard to borrow dollars in a bank account. It's very easy to borrow stablecoins from a system like Compound. And so this borrowing demand creates a yield opportunity for those people with stablecoins. And it's one of the things that actually pulls dollars from bank accounts into stablecoins in the first place. Is people say, wow, I can earn a 3% yield on stablecoins. Like I can't earn anything in my bank. It's 10 basis points, or it's zero, or it's zero plus fees, And so
is it the new gateway drug for crypto? It used to be Bitcoin, now it's stablecoins. It, as in a nice way, I'm saying it gets people to try it for the first time because it's so clear and the volatility is low.
It's a great analogy. I would say at this moment, stablecoins and NFTs are like the two gateway drugs that like get people into crypto that aren't there just to like speculate on the price of Bitcoin or Ether in the first place. It's extremely useful and interesting like on-ramps into the ecosystem. And if you're someone that's like boring, that like you don't want to go out and buy a bunch of Bitcoin and Ether, even if you think it's a great investment, you might be attracted to, oh, I can earn 3%. And the price of the thing doesn't go up, right? That's attractive to people who like boring. And so, this is something that surprised, I think, myself and the whole ecosystem is when Compound launched, there wasn't a stable coin as a supported market. And it wasn't until, Compound had been running for a while that stable coins really came into fruition. And it turned out that this was like the killer use case of a decentralized financial market like Compound, was to borrow a stable asset, which is much better than borrowing a volatile one, where your debt is uncertain. And earning a yield on a stable asset is much more exciting than earning a yield on a volatile one. So stablecoins have turned out to be this unbelievably important tool for global crypto markets.
Yeah, it's incredible. And if you think about it, even back in the day, if you would go to places like Russia or South America, even the 80s and 90s, the babushkas, they had dollars under the mattress, right? They knew. They had been through the ruble devaluations. They had been through the repudiations, all the wars and everything. They knew property or American dollars is where you'd hold that currency. And now you're giving them, it's not the equivalent, we can talk about it, but you're giving them, something like that digitally. And again, you make some points a lot of people don't realize. I mean, trying to get dollars out of a bank or move them geographically has all sorts of implications, from KYC and ALM and who's doing this and who's taxing this. And whereas with a crypto transaction, it's boom, it's moved.
It's instant. And you're seeing like that instant nature of it, changing people's minds on how crypto works. Like people used to say like, oh, crypto is so much like of a worse user experience than like the banking system and Venmo and all these things, right? Because it's like you have to have a wallet and like it's complex and there's seed phrases and like if it goes wrong, you can lose your crypto. But like at this point, stablecoins are just superior to wire transfers. They're faster, they're cheaper, they're instant. It's just like a better way for money to move. And so I think like it's winning over like the hearts and minds of people. I'm starting to see venture capital firms using stable coins to invest in startups instead of dollars because they can, close a transaction like the second that the docs are signed. I think stable coins are like this unbelievably powerful opportunity. And I think it's one of the most important trends for the US dollar. And I think it's catching the eye of, the Federal Reserve and regulators at this point. But I think there's like so much promise and opportunity to stablecoins that, I think the next couple of years are going to be a major turning point just in how dollars get used. And hopefully the world can start to embrace stablecoins, just making dollars more useful.
Good. Look, we got more to talk about, but I want to just talk about the downside of a stablecoin is that it's not a dollar backed by the US government. It's something that looks like a dollar, right? It floats like a duck, it quacks like a duck, but it's not necessarily a duck. And depending on the protocol, the biggest ones are Tether and USDC. They have collateralization and they're usually over collateralized, like I know you do on your platform where you over collateralize something. So if a market moves, there's a margin call, and perhaps we talk about that shortly. But they perform pretty well, those top ones, but we haven't, you could argue, have they been stress tested? What happens when the markets drop 50%? What happens when that happens fast? I know we have Black Thursday as an example, March 12th, where you could back up a lot of what you're doing with a collateral standpoint, but do we still need to test these stable coins a little bit more? And do people need to know that there's a risk? Because it says USD on the screen, but it is a very different instrument than a dollar.
Yeah, that's a great point. So stablecoins are minted by a business that says we're holding $1 of assets for every stablecoin we mint. And those assets, are generally safe assets. It might be deposits at banks. It might be commercial paper. It might be US treasuries. And they're saying we have $1 backing it. They look like money market funds in a very vague way, right? And, if you were to have like a tail risk event, like crypto collapsing, it's uncertain if everybody would want to redeem all their stablecoins all at once. Could the business that issued the stablecoin convert all the treasuries or commercial paper into dollars if everybody wanted out the door? That's unknown. I think, we might not ever see a major stress test of a stablecoin for the simple reason being that when crypto is crashing, the demand for stablecoins goes up. People want to exit their crypto into stablecoins and demand's only going, up. And, the demand for stablecoins only goes down when crypto is actually slowly going up, when people are saying, get rid of my stablecoins, buy more Bitcoin, buy more Ether, convert stablecoins into them. So it's hard to say, it's hard to imagine right now a market event that would cause a huge portion of a stablecoin to want to leave and like unwind the position at the same time. But that risk is there. And this is one of the reasons why people view there being tail risks to stablecoins. They might be 1 in a million, or they might be 1 in 1,000, or it's hard to say. But there is a very small risk that if you have a stablecoin, it's possible that it won't be redeemable one day for one reason or another. Now, this has never occurred, but that's the risk that I think, central banks are trying to evaluate in real time.
Okay, really good stuff. And again, just to say, the financial markets, as far as the yield curve of where you can borrow and lend instruments, it's such an important part of the growth of a financial market. And just as a bit of a background, on Wall Street, I guess up until the 80s, if you wanted to borrow or lend money at a fixed rate, you kind of had to do it at whatever there was a corporate bond or a US government treasury. And it wasn't until they created kind of fixed floating swaps with specific maturity dates and custom yields, which was my first book I traded, that you couldn't actually get a customized yield for a price. And it all happened because somebody innovated with this kind of off-balance sheet mechanism, and it allowed so many other aspects of the market to explode. Some will never even know, but it probably helped facilitate school loans, mortgages, car loans, insurance contracts, options, maybe, who knows? It made the whole market grow. And that probably could have helped people outside of the country as well. So what you're doing, sometimes when my students look at it, it looks small, but it's massive because it creates leverage and borrowing and opportunities, and it's just an important part that I think is really important. One thing we haven't talked about is this concept of a smart contract, and you mentioned Bitcoin early on, and that was actually, we'll talk about centralization too, that was centralized from the beginning, but it never actually got to that point where you could do more than trade a Bitcoin and actually have logic in there. Obviously, the Ethereum network provided that, which then allowed you guys to create these systems and all of this other great stuff that's happened. I think you said something one time. You said the most valuable asset is time, and the best systems are designed to make trust obsolete. And also you said earlier, we want to get rid of the bankers and replace them with software, which might sound like a bad thing to do, but I knew those bankers, they should be replaced by software, but it'll pass the savings on to you. How do you end up trying to explain to people what's happening there and why it is the future?
Yeah, it's a great question. So, there's certain, products and markets that are best run by robots, right? Metaphorically speaking. Where humans only introduce problems. They introduce, malice or error or like blunder or, there's all these things that can go wrong when humans are in the middle of it. And there's certain financial markets that are best run by just an open source piece of computer code. Ideally markets that are very simple and ones that benefit from transparency. And so, this is done with a smart contract. A smart contract just is a fancy word for a computer program deployed onto a blockchain. And, the nice thing about, whether it's Bitcoin or Ethereum or whatever, once a block has been mined, everyone can be confident that it's final, that it's not going to change. And so a smart contract is just a very simple computer program deployed into the history of the Ethereum blockchain. There's other blockchains now that can also support smart contracts. But once it's been deployed, you see this computer code and it says, if this asset does this, then do Y. And if a user supplies an asset, then do this. And it just manages, a financial activity. And it does so in a way that everyone can see, like anyone out there can like read how it works. It might take some like sophistication, but it's doable, right? And the whole thing runs on its own. You can think of it like a self-driving financial market. And just like eventually when self-driving cars are really good, there's going to be less accidents than when people are driving, right? It's also going to be better because like you can like fall asleep and the car will drive you. The same thing is going to happen with financial markets, where self-driving financial markets are going to be better than ones where you have to pick up the phone and call people to get something done. These DeFi markets are faster, cheaper, more transparent. They run 24/7. It's superior in almost every way, right? The biggest downside is that this is so new. There's like unknown unknowns. And that can include technical risks. That can include connected, risks of like financial markets. It's newer and that's therefore a little bit dangerous, but long-term, this is the direction I think almost every financial market's going to go. It's going to be run by computer code, not by people. And that's how I like to summarize it. A smart contract is just a fancy name for a computer program being used for a market like this.
Okay. Now, you earlier talked about how last year you were taking everything you built, right, and trying to give it back into the users in the community. This whole kind of decentralized autonomous organization or DAO type concept, which seems to be more in the forefront of blockchain development than, say, in your typical Silicon Valley tech startup. I mean, try telling Steve Jobs he's going to do that. I think that would have been a hard sell. But maybe I'm wrong. Maybe it could have been explained differently. I know that's your long-term goal. We've seen attempts of that. Just recently, Charles Hoskinson, who will be here in 2 weeks, was on an AMA and he said, look, he's like, I'm talking about this right now. I'm kind of the spokesman, but I'm not, this isn't mine anymore. This is supposed to be something else. This is infrastructure for the future. I think it's maybe a software developer's mentality, right? I'm going to build something that ultimately doesn't need me, right? That's like out of the movie Tron or something. Maybe talk about what you mean by that and how it can, I guess, maybe move an organization forward. And when you kind of gave it back, you gave the tokens back in governance form and also in value form, and maybe explain those differences.
Yeah, absolutely. So I like to start off by saying that if Bitcoin were run by the Bitcoin Corporation, it would be worthless. The value of Bitcoin comes from the fact that no one person controls it, right? And that means that no one can shut it down. It's going to run forever. It's like extremely anti-fragile, and it's decentralization is what gives it value. And if it wasn't decentralized, I wouldn't pay $1 for a Bitcoin, right? And its value and its strength comes from the fact that like nobody can like wreck it or mess it up. Now, I believe the same thing is true for financial markets, right? If a financial market is anti-fragile and like unwreckable, you have a lot more confidence participating in it or building a product on top of it or like, using it in any way, shape, or form. If it's going to be there in 100 years, it's a good financial market. Now, you can't apply this logic to everything. You can't apply it to like Nike. You can't like possibly make cool shoes, if it's not done by like a company that's really good at it. Like I can't even imagine how you would like organize like a distributed and decentralized group to like make shoes, right? But a financial market is actually something that fits really well with nobody being in direct control of it. And so this was the goal with decentralized and compound. And we basically went through this process of saying, instead of one company running it, we're going to roll out a system by which every single user holds control and governance in some proportion to their usage. And then all of those users can collectively make decisions about its future. It's impossible for one person to wreck the market, either by pressing the wrong button or making the wrong decision or whatever. And now it's in the hands of hundreds of thousands of stakeholders, most of which might not pay attention to like the day-to-day operations of the system, but enough that there's an extreme amount of visibility being put on the protocol. Changes to the protocol all have to be approved by a large community instead of just one group. And it creates like a confidence that the system's going to continue to work and will work, for hopefully the next 100 years. And I think that is done to make a stronger financial market, one that, isn't dependent on, the original developers of it, and actually gains strength and value by being put in the hands of the community instead of remaining in the hands of one team.
Right. And I think just to paraphrase what you're saying, if there was someone or something controlling Bitcoin, you wouldn't trust it enough, I guess, to give them $1 of your money because you would assume they might do something funny in the long run or try to change it in their way that they want. I won't make any allusions to the US federal government. We can talk about, printing money later. And again, that's complicated because they provide defense and there's all sorts of issues there. But you're saying the fact, since it is distributed and it's decentralized and it's not controlled by one person, creates the value in it, strangely enough. And so that's what a lot of DeFi companies are doing that. You guys were ahead of the curve, I think, in moving that forward and putting that out there. Let me ask you a question about governance. And I always wanted to ask someone, Robert, you're the perfect one. I spent the first 6 months of this year running to be the next mayor of London, all right? I had never been in politics before. As you know, 2020 was a crazy year. And we were interviewing lots of people that had different ideas about what we should do. Let me just say that. And I thought, you know what? I'm not necessarily agreeing with what the current people are doing, so maybe I should do something about it as opposed to just making some videos. So I ran and I got to see the democratic process at scale. And, it's not always the most functioning process. The media plays a big role in it. There's all sorts of weird things going on that I don't think we've seen yet hit token governments. But when it does, maybe strap your seatbelts in because, influence and media and all these other things play parts in it. Now you could say, well, that's better, Brian, than one person or one stakeholder. And I could agree, but it's also potentially got its own issues in the future. Maybe you can speak on that and also speak on maybe now the governance is still limited to a few major stakeholders, maybe even on Compound. Tell me if it is or isn't still mainly in the control of the big stake owners of Compound, like yourself and A16Z and Bain and your investors, and maybe just talk about that.
Yeah, absolutely. So this is actually a really interesting topic. And I think in general, we're at like a very early chapter of decentralized communities figuring out like how to manage a very complex financial market collectively. Now there's a couple models, right? The idea behind how Compound distributed its tokens is we wanted there to be essentially like a federation of people that were involved in overseeing this, much better than one, team, having lots of, dissenting views and competing views running a protocol. with the visibility, buy-in, and participation of every single user. So in Compound, every single user gets governance tokens, no matter how big or how small, but it's proportional to your usage. So the larger a user you are, the more tokens you have. And this is a model which has, I think 300 something thousand comp holders, right? Doesn't mean they're all large or they're all going to participate in running this platform, but they're all, in some sense, a stakeholder. With larger stakes done by those who have the most history and the most vested interest in seeing it succeed. And, this is a different approach from, call it complete democracy where every single user gets one vote. And you might have the crowd in its wisdom and its stupidity making decisions for a very complex system. It's in contrast to that. So it's completely scaled by a number of factors, but it's not designed to be equal. So the way the protocol operates is, there is an imbalance in the tokens. Over time, there's going to be less and less tokens in the hands of the original stakeholders relative to the community. And we expect that because the tokens are distributed to the users of the protocol proportionate to size, that the institutions and applications that are built on top of the protocol will amass the most governance and the most control. So you can imagine like a custodian or an exchange integrating this market into their platform. They'll wind up being very large stakeholders in the future of Compound. And so what's going to happen is it's going to start with, call it like the most professional stakeholders. And over time, it's going to go to the most active users, whether it's businesses or applications or exchanges using the protocol. And it's a system that makes it very hard for someone to lie, cheat, steal, or screw up because there's a lot of people watching. The likelihood that a bad decision makes its way through the governance process is very low. And it's designed for essentially slow governance. Things aren't changing very quickly. It's predictable, and you have to convince a lot of people to support a change to the way the protocol works. Whether it's a small change like, what's this interest rate curve in this one market, or a large change like how useful is this asset as collateral, making changes to it, requires a lot of buy-in, which I think is a very strong feature.
Yeah, and blockchain or accountability and government have never really danced much together. So I think that's an amazing thing to have, even with financial markets. I mean, I'll just say Robert alluded to during the crisis, basically the Fed didn't know the level of risk at some of these banks. And when I used to be at Bankers Trust, we would do trades on the phone, and it was a off-balance sheet transaction agreed between two counterparties. And we would never tell anybody the volumes we did. It was all secret. And that's how we kept our margins. It was control of information. Whereas the blockchain, you can't do that, which is great for finance and potentially even better for government. It's going to be interesting to see how it plays out. One final question. Do you have a governance token and also, I don't know if I call it an equity token or a token that has a kind of a share in the market cap? And are those separate? And is there a point where companies get too many tokens? What do you think is the future, capital or a governance structure like that?
Yeah, it's a really interesting question. So there's a single token called the Compound Governance Token, which runs the protocol and is essentially the owner of everything inside of the protocol. There's only a single token, and this is for simplicity. I think over time you might start to see, in all DeFi applications, different experiments being conducted, separating voting from, economic ownership. You see this in different class structures of equities on publicly traded companies. You have common stock, you have preferred stock, you have all different approaches to slicing and dicing the relationship.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.